Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. It's part of our year-end series where we look back at 2022 and look ahead to 2023. And with us, we have Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank, coming out of Singapore. Now, Vishnu, it's always great to have you on the show.
Hi, Brian. I should be the one saying thank you. It's always a pleasure to be here.
Now, Vishnu, for a start, we had a very turbulent 2022. Could you give us some insights into the highlights and events of the year and some of the themes for the year, but then give us some overview through your lens, through a historical lens of what perhaps were the precedents of different events that have caused the year to pan out the way that it has?
I mean, Brian, you're absolutely right. It's been a very complex year with many complicated factors, from war to trying to exit COVID to the Fed's tightening policy. And my occupational hazard is I'm going to focus somewhat more on the policy aspect of it and try to weave a thematic picture of how we went through 2022 and what that might mean for us in 2023. And I think it's much better to see evidence than my face whilst I'm talking about it. So here goes, if we can pull up this chart. So what I wanted to bring us through is the elephant in the room, which is the Fed on its tightening cycle. They've raised rates by more than 400 basis points. So now you've got rate at 4.25%. It's going to hit higher. What the first chart here tells us is a story based from our evidence from the 80s. Whenever the world was in an economic expansion cycle and it encountered a Fed tightening cycle that came with it, almost always, these gray bars are all the recessions that we have experienced. The recessions have almost always been triggered by a Fed tightening cycle, so to speak. The global growth has very rarely died a natural death, and it's all been caused by policy tightening. And as we go into this year, despite the levels of rates not being as high, the sheer quantum of rate hikes that might reach above 500 basis points, historically, one of the highest post-Volcker, suggests that recession risks cannot be discounted. More so, if you consider this, I mean, this is the Fed's tightening cycle over a number of months, and we've taken it since the 70s right up to now, and the red line here is our current cycle along with projections. Similarly, for the ECB, from their 90s cycle, we've taken over the months, how they've tightened, and the red line is again their most recent cycle. What this tells us is, on a global scale, the two biggest central bankers, the two most prominent ones, are tightening at the fastest pace in a long history. So it's not just any tightening cycle, it's not a garden variety, it's one of the most aggressive cycles. And this is why global markets perhaps may be quite justifiably fearing recession risks. And speaking of recession risks, one of the barometers, the canary in the coal mine, so to speak, is what you call a yield curve inversion. That's to say, your longer term interest rates or yields being lower than your near term. If you look at this chart here, we have taken a few measures of that. You can take a 10-year minus 2-year, or the Fed's preferred 18-month minus 3-month. Whenever that turns negative, the yield curve is inverted, and we're showing you, yes, whenever that inverts, it usually warns of a recession to come. Right now, we've got the yield curve inverted dramatically, and where once the Fed had the defense of saying, no, their preferred measure is still positive, they no longer have that. So we can put aside all this technical debates. A recession risk is growing prominently. And two things about the yield curve inversion is the depth of the inversion matters, as does how long it's inverted for. So to speak, the duration. Currently, the inversion is over 70 to 80 basis points, and it's averaged about 40 basis points. And that's very significant. Historically, these depths of inversion has triggered a recession. And now we need to look at how long it's been inverted. We are knocking up against 23, 24 months. Historically, our evidence is 40 to 80 months is the lead time that an uninterrupted inversion warns of a recession to come. So which is why markets are beginning to extrapolate this and say somewhere in the second half of next year, the global economy is going to start to falter, and they think the Fed will pivot in a big way. And by this pivot, I mean start cutting rates rather than hiking rates, even though the Fed has warned there is more rate hikes to come next year. And exactly
So
how
this is
far apart.
quite a difference compared to the narrative that the average investor understands. Average investor is now listening to the Fed and saying, aha, we're going to have higher for longer. It's going to be till the end of the year. But what you're saying is the data and historical data is now telling us the Fed will start to perhaps pivot already just in the early part of the second half of the year.
I mean, basically, that's what markets are thinking. Markets are thinking, if you look at the data and the recession risks that the data suggests, they are thinking that the Fed will blink. So the real question is, will the Fed blink prematurely and then try to avert a recession, or are they going to say, no, we've got the stomach for this? Let's get into some kind of a downturn, because that's what's required to durably tame inflation. That's the real difference, because in the latest so-called dot plot, so every quarter, the FOMC members will say where they see the Fed rates by the end of every particular year. The latest one that came out in December, the Fed in 2023, the purple bar is their revised December forecast versus the yellow bar being September. So they've become more hawkish. They're saying they see rates between 5 to 5.25% by the end of 2023. Markets are conceding that the Fed will hike a bit. So this is how markets are pricing the cumulative rate hikes. They're going into the middle of next year. They say the Fed might bring rates up to 4.75, so not below where the Fed says. So it's calling the Fed's bluff, so to speak. And by the end of next year, they're seeing rates going down to perhaps even below 4.25%. And so the markets and the Fed are 100 basis points apart. This can cause quite a bit of consternation, and perhaps together with that, some volatility going into the middle of next year when we begin to find out who's bluffing and who's been caught in a bluff. So that's one of the things we want to look out for.
Now, finally, yeah, go ahead.
No. So finally, if you want to extrapolate that and say, what does this mean for markets? Higher interest rates, does it mean markets will be lower on global equities? Or should we then think, no, hang on, if we think the Fed is going to cut, then maybe markets may start to rise. Both arguments, depending on the context, have got some backing, some grounds for it. But the one thing we should do is take a step back and look at global liquidity, because we're just speaking about interest rates. And one big function that has changed is global liquidity. Since the GFC, the Fed and other central bankers have put in a lot of global liquidity that have really enabled asset markets to price much higher. And this chart here shows this. So this is showing your MSCI Global Index annual changes. And we've highlighted those parts where there were crises or downturns. But if you look at it on a rolling basis, the picture becomes much clearer. We start in 2000, the dot-com crisis. You can see it was indeed a U or L-shaped recovery, because it took a while to go down. It kept dropping for a while, and it took many years to recover back to pre-crisis levels. Whereas once 2008 got past us, we got QE that got bigger and broader. The Fed made bigger infusions, and more central banks joined in. You can see that all the rebounds in the equity markets have been really quick and really pronounced. Now the warning is that going into 2023, if you look at this chart, this is how much liquidity the major G4 central banks are putting into markets or taking out. On an aggregate basis, they are taking out liquidity for the first time in more than a decade. So now that liquidity is being drawn out, we perhaps need to reassess just how much markets can bounce back with the same vigor. So that's about the big themes that we're thinking about as we get into next year.
Now then, Vishnu, what are you advising your clients to do in 2023?
We're going to say keep the the seat belt on. That's one of the things that we're telling clients. We're saying, yes, going into the end of the year, it seems like markets are starting to bet on the Fed pivoting, and so we're getting past the worst of Fed hike risks or China risk, because China is reopening. We're just saying there's going to be some disappointments in the first half of next year, whether it's China's reopening being much slower, or it is due to incoming data suggesting the Fed may not back down so fast. There will be some reassessment early next year. So it's going to be a bumpy path out. And the second half of next year, instead of worrying about policy or the policy implementations, second half we start to really stare down the barrel and wonder whether we'll have a global recession. That may be harder to avert. And that's when we think, the consolation is that commodity prices and interest rates and yields may come down, but then so will growth, and then the challenge the set of challenges we face will be an entirely different kettle of fish. So we are telling clients to keep eyes open, keep a bit more cash, especially as global liquidity is being drained, and also watch out for more upside risks to yields in the first half, but some volatile markets going into the second half.
Now, Vishnu, as always, thank you very much for your insights, and thanks a lot for coming on the show.
My pleasure, always, Brian. Thank you.
Now, we've been speaking to Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank on BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. I'm Brian Fernandez. This interview will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.